Hi, everyone. Welcome to another KE Report webinar produced in conjunction with Focus Communications. Again, my name is Cory Fleck. I am your host and president and host over at the KE Report. In this webinar, we are featuring TriStar Gold, traded on the TSX Venture Exchange under the symbol TSG and on the OTC QX under the symbol TSG.ZF. I am joined by the president and CEO, Nick Appleyard. Now, Nick is going to take us through company presentation. We're definitely going to touch back on that key news release that came out back on Monday, October 5th, that is the PFS on the company's project down in Brazil. Now, I will be interjecting questions throughout this webinar, so please use the chat and question feature within this webinar program to send those questions to me, and I will bring those up when it dictates and when it fits into the certain time constraint. Now, Nick, I'm going to throw this over to you, but again, I am going to be interjecting different questions here. We've already received a number of questions, a lot focused on some of the PFS data. So, Nick, again, well, thank you for joining us. Everyone send in your questions. And now, Nick, take us away, please.
All right. Thanks for having me as always, Cory. All right, well, let's jump right into this. As usual, we will be making some forward-looking statements, so please, understand that there is risk involved in that, and do take a chance to read through this if you have some time later on. But we're trying to give you the best information we can, but and we're going to do the best we can. But there is some forward-looking stuff there. So, as Cory said, we've just announced our PFS. We've been working on this for a while, and personally, I couldn't be prouder of my team and the project. We've got 1.3 million ounces production. We're hitting, the target rates that we wanted to. We're showing that phase one, Esperanza South, is producing basically 150,000 ounces a year. We've got a really quick payback. We've got a really low all-in sustaining. So, this project is coming up and is just delivered again now with this much more detailed project. So this is just a summary slide giving you a quick catch of everything. And I will now step into it and give you a bit more detail over the whole project.
Perfect. We'll get back to some of these PFS questions as well, because I know some people want us to dive into it. But let's take care of the company first here, Nick.
Okay. Just a quick touch on this. We're still, I think the important thing is we've still got a good treasury. We've still got somewhere close to $7 million in the bank. That's going to get us through, keep us moving forward now. There's no need to do a PFS and stop and have to desperately raise money. We can keep working, and as we look forward into the future of this project. This year, as people may not have noticed, we have really strengthened our board with the additions of Jessica Van den Akker, Mike Isto, Eric Zanschaub, highly technical, highly advanced, great professionals who just make this board stronger and make it more of a board of a development company rather than exploration. So it just shows the growth and the maturity that this company is going through. We still have coverage from Cormark and Paradigm, and hopefully they'll be updating what they wrote on us as they dive into all this information on the PFS as well. General background, I'm sure most people who are listening are aware, but it's Castelo de Sonhos in central Brazil and right on the southern border of Pará state. We have 100% control of this asset. And just the major things to point out, it's a paleoplacer. It's like similar asset mines like Jacobina and Tarkwa, so it's not something new and unknown. It's something with some very profitable mines using the same model. We're really lucky. We've got Highway 163, we've got power lines, we've got access, we've got a village and town and labor force near us. All of that has played in very nicely into this PFS. And of course, obviously, we've got the PFS. Our resources have grown again. After the investment from Royal Gold, we've now got economics that we can stand up and not have to say this is a conceptual guess as we did in the PEA. This is, backed up by engineering and backed up by reserves, and under 4301, we can now say we've got post-tax IRR 28%, NPV5 $321 million. It's a real asset. This is a really good project, and for me, this is probably now the preeminent development asset in Brazil held by a junior. Who knows what some of the seniors have got, but in the juniors, I think this is the best one. And it's still young in its life cycle. That's the other thing I'd like to point out on this slide. We've still got a lot of exploration to do. We've still got a lot of development to do. This thing's just starting up.
So, Nick, does that mean that the company is going to be balancing out, potentially moving more into development or a construction decision with still a lot of exploration drilling to be done?
I think to me it says that the development's going to be the core of the company moving forward. Now, there's always going to be exploration going on, to extend the development life or even to find something new and exciting. But I think the core of our focus is development now, for sure. We've got a great asset which is going to be adding value, and we've got to develop it, keep it moving forward. So this is the general layout from the PFS. You can see we've got Esperanza South, Esperanza East, Center. We've got assets and all. We put the processing facility close to Esperanza South because that's where the best mineral is. Tailings dam, again, just downstream from the processing facility, and as you can see, power lines heading out to the highway. It's just a neat little project. There's not much to say about the layout. It's simple. It's logical. There's nothing untoward here. There's nothing unusual about it at all, really. It's a very standard, shallow open pit mine. The one thing we have done on this is it is a bit bigger than the PEA, and it's grown nicely. But that's where we are right now. One thing we have done now, having looked at this and worked through it, we've broken the project into two phases. Find it easier to talk about phase 1 and phase 2 rather than Esperanza South and then Esperanza Center and East and any other satellite deposits. And really that's driven by the fact that we've seen the economics are so much stronger in Esperanza South, which is now phase 1, compared to everything else. And that has a big impact on everything we do. It has on how we lay out the project. It's like, okay, you don't put the plant central to Esperanza Center and East, and they don't really come into it. It's near Esperanza South, and then the dam is downstream from that. Everything's focused around Esperanza South, and also it'll help us with our, how we advance the project, how we think about moving forward from here, where we spend our dollars to add reserves, add resources when we can. It's going to be, if we can find more Esperanza South or phase 1 style material, that's where the high profit is. So that's sort of, it's something we've learned from the study, I would say, rather than something that we've put into it.
What is that high profitability material? What kind of grade are we talking, and how many ounces are involved in this phase 1?
Well, phase 1 is it's about 1.3 grams a ton, the average grade down there. From an economic point, I think it averages $850 all-in sustaining through phase 1, and it goes up to about $1,000 in phase 2. So that's where you can see that for me, that's the sort of the end of the line, the stark difference. Do you want to be paying $850 an ounce or $1,000 an ounce to make it? It's quite a big jump. How many ounces? I haven't actually looked, but I would presume that 2/3 of the ounces produced, so nearly 1 million ounces, are coming out of Esperanza South, out of phase 1. Okay. And again, I think the big thing for us is, even if you just look at the shape of the pits there's gaps and there's bulges. There's a lot of work to do that we think we can do to add on and extend that. So now we've got 6 years life there, push that out to 8 to 10 years life, and all of a sudden you're looking at a project which hasn't got 6 years at 150,000 ounces a year. It's got 10 years at that, plus another however many 4 or 5 years at lower production rates. The tail of the project. So, it's all looking good.
Okay, so there's still expansion opportunity in that phase 1, then, that resource.
Massive, yeah. There's massive expansion opportunity there.
Okay.
So just as we're looking at these, are just sort of some life of mine costs that have gone into it. We've obviously got Capex now, $261 million, and you can see the makeup of it there. You know, a little higher than we were before, but it's pretty easy to explain. The operating costs, again, we're now at 10,000 tonnes a day. The costs are in line with what we expected. There are some changes from where we were before. Going from a contractor mining to an owner-operated mining means there's a little bit more Capex and lower operating costs. But everything else is sort of in line with where we expected it to be. And the costs have been one of the tougher areas to tie down during these strange times we find ourselves in.
Was that because of the escalation, I guess, in energy costs and the variability that we've seen in a lot of raw material costs?
It's the escalation that we've seen in costs, like from 180 million to 260 million Capex, say that, you know, I think we've got a 20% bigger plant now. We've got a $40 million mining fleet in there now. But you do have seen escalation through COVID. Some of the challenges I think we've been doing is getting good quotes from people right now. It's people are busy. There's supply chain issues, and you know it's hard to get a real price on sometimes right now. But we are seeing some escalation. We have seen some go both ways. We've actually got a lower power price now than we had before, and that's because there's been more power supply put into the region to support the soybean industry. So we sort of benefit from that. You know, we were at 10 cents a kilowatt hour. I think we're at 7 now. So that it has gone both ways. There have been some areas of great benefit to us as well.
Now, Nick, can you give a little bit more insights in terms of the decision to be an owner-operated mine here rather than contract mining?
Yeah, there's a few things that went into it. I think for me, we have a little rule in the company: you're only allowed to ask questions and you're only allowed to answer them in your own field of expertise. And I'm not a mining engineer, but it always seemed intuitive to me that if we're processing, you know, through a plant 10,000 tonnes a day, and we've got a life of mine strip ratio of 9:1, which means average through the life mine, we're moving 100,000 tonnes of dirt a day. You know, you're going to pay someone else a profit to do that for 11 years, or do you want to do it yourself and keep that money? So it always seemed to me that it would, at this scale, you're going to be better off doing it yourself. And then also, as we started getting quotes from the contractors, or trying to, you know, but they were busy. They had supply chain issues getting new vehicles and new trucks. And, so we couldn't get sort of sensible quotes out of contractors. So it seemed like a good opportunity for us to draw that line in the sand and say, okay, we're not going to do that. We're going to have our own fleet, run our own mine, which is my preference anyway. You know.
Okay. Can you just break down the strip ratio? We had a quick question. What is the expected strip on Esperanza South? Can you kind of break it down from the phase 1, phase 2 difference?
Yeah, I haven't got the exact numbers, but I know that phase 1 is between 11 and 12 to 1, and phase 2 is around 5 to 6 to 1, with a life of mine average at 9 to 1. Okay. Which is interesting for me because, you know, we do get questions on the strip ratio, and to me, the strip is just one cog in a big machine. It's an important one, but it is just one cog, you know. And here you've got a very clear example of, you know, set phase 1, 11 to 1 strip ratio, phase 2, 5 or 6 to 1. If you know, pretty well anyone out there is going to choose phase 1 over phase 2. It's a much better mine. It makes a lot more money. You know, you're over $100 an ounce, all in sustaining lower on that, but with a higher strip ratio. So it does show you that it's something to be aware of, but not something to be scared of, you know.
Okay, thank you.
So the way the pre-feas goes, obviously we got a layout. Then with the layout, we work out our costs, and then we get to some results. As we said, personally, we're super proud of this. You know, we've now got these 33 pre-tax IRR, 28 post-tax, 321 million NPV, all in sustaining 900. These are all good numbers. You know, and I know some people looked at the PEA, and I think the thing to think of is as gold prices move up, all your costs move with it. And what you're looking at is, can you maintain your margins? And beforehand, we had $700 all-in sustaining and a $1,250 gold price, so we were $550 below gold, spot gold with a margin. Now we're at 900 at a $1,550 gold price with $650 margin. So we've actually expanded that margin, made a mine that's going to make more money per ounce, you know, than we had before. So I think that's excellent, and it's again exceeded our expectations. You know, The other thing that's been really good on this is, we're now making 1.3 million ounces of gold. That's 20% bigger or so than we were at the PEA as well. And, we're still getting very quick payback, and we still have a nice long life now of 11 years. So it's all really, really positive.
Now, what about using that $1,550 gold price? What was the decision behind that?
Yeah, it's always tempting to go and use a nice higher one. I believe the 36-month trailing average is 1,600 now. But you sort of want to leave yourself a little bit of upside as well to talk about in the next week and the week after. But it seemed like a good area to be. It's sort of it's a pretty good trailing price to use. It's fairly generic right now that people are using 1,500, 1,550, maybe up to 1,600 as a reserve base price. So it obviously, as we'll get into the sensitivities, we'll be able to show people at closer to spot or closer to 1,800 what the economics are. And obviously that's important as well, because gold from 1,800 can go up and can go down, and if it goes up from there, it's not too far to 2,000 again.
Yeah, that's fair. And in all fairness, it is standard to at least throw a 1,500 in around that area number just to show that the project can be profitable at lower metals prices. What about the exchange rate too? We've had a couple of questions come in regarding the exchange rate there, the 5 Brazilian reals to $1 US. Obviously, you guys are exposed to some sort of currency sensitivities here, but using that exchange rate, what have you seen in the exchange rate as well?
Yeah, again, we've got a bit conservative. I think the current rate today is about 5.5 to 1. So again, we're about 10% below. And it has a big impact. One of the advantages of us using Brazilian engineers on this, they understand the taxation and the import duties and all this, and the benefits in using equipment and machinery and know-how derived in Brazil that attracts a lot less taxes. So we have had a real focus on doing as much of the work in Brazil, sourcing as much equipment through the quotation systems in Brazil as possible. But that then means you're doing stuff in Brazilian reais, and it does have an impact. So I don't know the exact impact, but there is quite a sensitivity to the exchange rate. So there's another bit of upside there for us. If we went to 5.5 to 1, you would see an improvement in economics, a noticeable improvement.
Okay.
So talking about some sensitivities here, it just shows you the NPV and IRRs at various prices, and obviously gold today is around 1,760. So if close to that 1,800 bar, you're looking at 628 million NPV5 post-tax, 45% IRR. Again, sensational numbers. I'm a risk-averse person and conservative, so it's nice to see that as you move down the chart, you're still making money as well. And obviously, as gold price moved a long way from where we've done the studies, other parameters would start to change, and those curves would flatten out or change. But, again, it just shows you a really strong, robust project that's making a lot of money. This is sort of to highlight the differences we talked about here in phase 1 and phase 2. We've got phase 1 in green there, which is effectively Esperanza South. And you can see the all-in sustaining there is nice and low. It averages 850 through that period. And you can also see that you're basically producing about 150,000 ounces of gold a year through that period. As you head into phase 2, which is moving out to Esperanza East, Esperanza Center, your all-in sustaining average is about $1,000, and you're making averaged about 90,000 ounces a year. So it's still profitable, still nice, but it's really clear to us that, okay, we've got to focus on another more years of Esperanza phase 1. We'll go straight to the bottom line a lot quicker than us drilling out east and center.
Yeah, it does really stick out there, that phase 1, how much more profitable it is. But can you also discuss the additional costs when you do move to phase 2, what that entails? Because we've talked about the initial Capex here, but what about the additional cost to bring in that phase 2?
There's not a huge amount of cost. There's a bit of road building got to go in. Obviously you've got your normal with our own mining fleet. We'll be regenerating that several times through the life of the mine. and then it's just the added on size of the permitting area, roads, getting power, getting dewatering to those areas. It's not a huge extra cost to go out to there.
Okay, thank you.
There was something else there. Oh, that's right. Yeah, so this is the big thing now. Obviously, we've never had mineral reserves before. It's really nice to get this as obviously the basis of the whole PFS. We have probable reserves. We have not got proven because we didn't drill out to measured resources. That's for our final feasibility. But probable reserves now stand at 1.4 million ounces or 1.1 grams a ton. And again, you can see the phase 1 material there is 1.3 grams a ton, and the phase 2 is 0.8 of a gram a ton. It's fairly obvious and clear. Seems logical, but sometimes before this, even things seem logical. You think, oh, maybe we'll drill, maybe we'll find more of that, maybe a little bit more profitable. But it's clear now what we have to do and where we want to go.
Now, what about the global resource too? Because these are just the mineable ounces in the probable category. Yes. What about bringing or upgrading some of the other ounces that are known?
Yes, I'll just jump forward. So these are we actually did update the resources in this final press release. So we now have 1.8 million ounces of indicated globally and an additional 700,000 ounces of inferred. It's just drilling to upgrade it, But I think where our head is now is like, okay, we've thought before, we could upgrade the inferred out of Esperanza East and Center, but I don't think that would be a good spend of the money right now. So we're going to be focusing, and we've asked our partners, Gold Spot Discoveries, to use their machine learning and artificial intelligence in a very, very focused way. It's like, here's the parameters of what we're after. Where should we be drilling? And and that's what they're working on as we speak now for us to help us define that drill program, which will find us more 1.3 gram per ton material, or higher if possible, But that phase 1 style material is what we're chasing now.
So is there going to be a balance then? Future drilling in terms of exploration, trying to find more of that phase 1 material, so growing the resource, but then also moving some of those proven or probable ounces into proven and even upgrading some of these inferred ounces?
Yeah, I think there will be. I mean, there's obviously going to be some drilling which is going to be aimed at expanding the indicated and probable reserves in and around the phase 1 area. At the same time, you're going to be just pattern drilling sections of it to get your measured resources, to get proven reserves for final feasibility. So I think you'll have sort of twofold exploration there: near mine expansion and infill.
Okay, thank you.
Yep. But there is still, on this global resource, there is still a lot more to go. So when we sort of say, well, we're not going to focus, it doesn't mean there's not a lot more of that 1 gram material out there. It's just that's not the most highest profit stuff. That don't need to go for it yet. Mm-hmm. This is just showing a little bit about the mining operations, and again, it sort of just shows the distinction between phase 1, phase 2. You can see the grey line is the head grade, and it really drops into year 6, 7, out to 11. And again, the amount of material you're moving per day drops as well. But it's that high grade, high strip, high margin material that you're going to want to add on to for future drilling and for future operations. I also think there's the other thing that I would like to mention in this is there is still a lot of room for optimization. We haven't done any sort of plant optimization. We haven't done any throughput optimizations there, but we have designed a flexible plant at maximum recovery, which gives you the opportunity, or gives us the opportunity as the operators in the future, to do quite a lot to optimize even that phase 2 zone. Okay, we go, okay, right now we're getting 98% recovery on 0.8, 0.9 gram material. If we throw 30% more material through the plant, we might only drop a couple of percent recovery. You might make more money, and there's a lot of tweaks to be done like that. It's sort of too early. We don't have enough detail to do those optimizations yet. I mean, we could do them now, but it becomes an empty sort of operation on a spreadsheet with no basis in reality. But as we move forward, those things can do. So there is still upside and still optimization within the study itself, and more ounces to be found, you know, and added into it.
Okay, that optimization, it all helps for margins and for profitability. When would you get to that then? Would that be more in the feasibility?
In the feasibility, yeah. And obviously when you're in operations, you're doing it continually. So, but you need that next level of detail before you can start doing that. And also if we sort of try and do it now, you get a bit of a false sense of how much you know and how much you can control. But there is quite a lot that can still be done to optimize this and tweak it and improve it. So,
fair enough, especially with some of the exploration upside too. That sounds like you still have.
Yeah. We can also look at the mining fleet, how we're going to run it, how we're going to. I mean, this is our first look at our owner operated, so there are tweaks and changes to be done to that as well. So there's I keep saying we're very early in the life cycle of this, so there's still a lot to learn. But the one thing that's really been consistent is if you look back at some of our press releases from, I think it was January 2016, we sort of told the investing world exactly what this project had and where it was going to get to. And and I can't be prouder of my team than the fact that we've got there now, and we've fulfilled what we said we were going to do 5 years ago. If you look back, those parameters are almost perfect. I mean, it was changing gold price, changes in cutoff grades. But it's it's been a very predictable deposit, which means that it can hopefully continue to be, and that lends itself really nicely to a business plan and a mine that'll make money.
Okay.
Well, that is it. That's us, our PFS there. And as I said, I think this is, for me, it's clearly the preeminent development asset in Brazil, held by Junior. It's still going to get growing, and it's moving forward rapidly now. And we're happy to answer any questions anyone has.
All right. There are a few questions that came in here. Let's start with permitting. What permitting do you still have to go through? When do you expect it to be completed? What insights can you give us on the permitting front?
Okay, yeah, we've been very busy on permitting in the background. We've been doing all the baseline work, but we've also sort of targeted the highest risk areas, within Brazil, within the region we're in. The risks are if you have an indigenous population near you, or if you have any population that would need moving. You have caves, which may be signs of previous inhabitants, pre-Hispanic. So those areas we focus, obviously, we're not near an indigenous population. There are no people living in the area that would need to be moved. So those are two big red flags that don't exist. We've done a big caving study, and waterfalls are the other big issue that they're very sensitive about. We've done those studies. No red flags have come out of them. There are some small waterfalls, some small caves, but nothing that shows any human inhabitants. Nothing that's going to cause any issues to permitting. So now we're still moving ahead with the rest of the process. We have, I think, another few months of data collection to go in our baseline. Now we have the project layout then that we'll be completing our EIA Lima, they call it in Brazil, and that'll be filed early next year. And then you'd hopefully get, I think, your environmental license about a year later, and then another 6 months or so for your construction license is what we'd be looking at.
When would the construction decision come into play as you move through these hurdles?
It's a good question. That usually, you've got to have enough confidence. You'd want your feasibility study, and you'd want to know where your money's coming from to build it. So that sort of all comes together at the same time as the permits come available. You'd want to be making a decision, basically on the back of a feasibility study.
Okay, that makes sense. We've gotten a few questions about the exploration and targets. We've touched on the exploration. You said that you are out there and going to be exploring, trying to build up some more of those phase 1 type of ounces. Can you give us any more insights on where some of these near-term targets are?
Let's see if I can switch back to one of these diagrams with a map. It's moving slowly.
It's going. We're going to get there.
If they're on it seems to. Okay, here we go. So I'm going to try and draw a little bit. So realistically, I think what we're looking at is, for phase one extensions, there's a lot of space here. We see areas in here and also at the back. That they're the sort of the most obvious areas for phase one extensions. And that's what we've got Gold Spot Discoveries working on. We still do have, obviously, we've got conglomerates out here and around here that we'll be looking at. I think they are lower priority because they're steeper. They're going to add small pits, sort of like Esperanza East and Central, to the deposit rather than something big with millions of ounces. Because they're so steep, the strip ratio will come up too high and you get no depth to it. We talked in the past about the Deeps deposit, which is in the middle. That's a hard one to hit. We've got a few hits in it, and it's sort of teasing us a bit. We'll continue to evaluate that as a real exploration, which is higher risk. But I think the majority of our stuff is going to be focused on this area here around Esperanza South. Also you think of the time frames we have. If we're going to get it into production, permitted within 18 months from now, it's going to take us 3 to 6 months to get here and start drilling and get these added into the project before it gets permitted. So we want that in there now. And if we're looking at how it's going to get permitted, how it's going to get financed, this is where the value is easiest to add to the project. So.
Okay. One other question here. Asks about the potential for high wall pushback at Esperanza South, rising gold price if ore continues down dip with depth. Any insights on this?
Yeah, absolutely. And I think the answer is, even as we have it now, we probably haven't drilled deep enough. We see that we end up with some flat bottom pits, which means they bottomed out on the indicated resource. If we'd have drilled another section or two of drill holes, they would have probably already gone deeper. So absolutely, yes. And one thing a little bit intriguing on that, we have an area down in here where you actually got a slope, like a dip slope going down there. And that's something we want to test, because it could be that the slope ends up paralleling the ore body down below. So we want to get down below and test that as well. But yeah, absolutely. If gold price moves up, you would definitely be putting another line of drill holes in there and following it down dip.
Absolutely. Okay, let's talk a little bit about the resource then. Somebody's asking, has any dilution been considered within the resource and reserves?
The mining engineers at G21 have considered both mining dilution and ore loss in the mining operations themselves. The way the resources were done, you don't put mining dilution. The terms get very confusing sometimes, but there is just the appropriate statistical analysis of the gold grades. As you get larger blocks, you get lower grades. I wouldn't call it dilution, but it's just volume variance effect is what we really discuss it as. But yeah, I think what the question probably focusing on is, have the mining engineers include dilution? And yes, they have.
Okay,
really
perfect.
Number offhand, it was done a few months ago. I've had so many numbers go through my head.
Yeah, fair enough. Simple enough too. Well, what about metallurgy? Anything that you guys are considering? Anything to be aware of? This does seem like a pretty straightforward dig it up, run it through. But what about metallurgy? Anything that you need to be concerned about?
This is the simplest one I've ever seen from metallurgically. Like, we're running 98% recovery. I know we ran our last 6 tests through the labs. I think in 3 of them, they failed to detect gold in the tails, and they had to use the detection limit of the lab to calculate the 98% recovery. That's what that 98% is. It's not the fact that they calculated we could recover 98%. It was the fact they couldn't get anything finer. But I think the thing for me with the metallurgy is that potential optimization. Right now, we are crushing to 105 microns. We could get maybe out to phase 2, or with a low grade material, and say, okay, well, let's crush this to 250 microns, and instead of running 10,000 tons a day, you might get 12 or 14, I don't know what it would be, but a lot more material through the same plant, and probably only drop your recovery. Well, those are the studies that got to be something, whether it goes from 98 down to 95 or 92. But if you're getting 50% more material through the plant, through the same capital of equipment, you can really do some optimization like that. And those are the sort of things we'll be looking at on the next phase. And really, it's just the beautiful metallurgy that we have allows us to do that sort of work. The other nice thing that's related to metallurgy, the chemistry, the geochemistry of the rock here, is that we end up with very, very inert, sterile tailings because we have no sulfides, we have no deleterious elements at all. It's just effectively sand. Because after cyanide destruction, there's just sand and water goes down, and the water is recycled back to the plant. So it's really good.
That actually answers another question that was asking about some of the environmental concerns that could be for this project. What about the political aspect when it comes to Brazil and building mines? There are mines operating there, but what can you give us in terms of insights into Brazil?
Brazil's a mining. It's a mining country. It's much like my home country in Australia. It's a mining country. You go down to Belo Horizonte, where I usually head to. Pretty well everyone there has someone in their family who works and survives and on mining. They understand it's part of life. So Pará State, where we are, is again a major mining jurisdiction. There's some of the biggest iron ore mines in the world. The state government knows the benefit to them of mining, and they promote mining actively. So you've sort of got the wind behind you. It's a benefit. I think I always think of it much like, well, as I said, Australia or America or Canada. If they're countries that do a lot of mining, but you still want to be in the right state. You'd prefer to be in Nevada rather than California. Here, you'd rather be in Pará than Rio de Janeiro. So it's the same thing. We are in the right location for permitting and also for infrastructure. So it's fantastic for us.
Okay. A couple more questions then, mostly just dealing with, and this is a bit longer time frame here, how the company would secure financing for the capital build out here. Again, this will take time to even go through a construction decision. What are some of the options you're looking at?
Yeah, we haven't got that far ahead. I mean, we're thinking now, how do we get, where's the financing come through to complete feasibility and permitting and start basic engineering. And then there's various options available to us for that. Beyond that, we haven't. I mean, if this project, and there's no reason to believe it won't, stays this good and we can expand it a little bit, there's going to be a lot of alternatives available for us. So, it's not something that worries me or keeps me up at night. We've just got to get the next milestone, turn this into a full feasibility study with a fully permitted asset, and you've got something which is golden, So there'd be a lot of options on how you put it into production.
Well, and one of the options that keeps getting brought up here is, what about any sort of merger with any other well-established Brazilian or South American juniors? We've seen mergers in the space. Have you guys considered this? Are there any kind of synergies with anybody else?
Yeah, we've looked at it and thought about it. Obviously, I'm always thinking about it. The other alternative to merger would be a slightly an intermediate-sized producer coming in and taking 20% of us and helping us finance through that way. If you want to merge with something, you want to make sure that there's benefit to our shareholders and to us running the company to do that. And so you want to be careful not to merge with another junior, and you've still now got their asset and our asset, and trying to find out how you're going to capitalize both of them. You want to bring in complementary sets, complementary projects. So maybe a merger would be of equals would be a bit of a tougher one, I think. In general, you do want someone coming in bigger who can really help drive this thing forward. And obviously, if it's someone who's bigger and they've got the permitting experience in Brazil and they've got the engineering experience in Brazil and they've got the contacts with the government and everything like that, it's all that would all be benefits to a structure like that, and beneficial then directly to our shareholders.
All right. Nick, we're going to wrap it up here. I'm going to give you one more chance here just to summarize what investors should be looking for then coming out of the company, catalysts as we move into next year now that this PFS is in the market and has shown some profitability at this project.
Yeah, I think if you're looking forward to, obviously we're going to be working on this, getting the technical report out. That'll be the next thing that comes out. We will be starting that drilling at some point, hopefully expanding that phase 1 reserves, pushing that out. We will be giving sometime in the near future more detailed summary on the permitting, because we do get lots of questions on that, and we were going to put that out there and for everyone to see. And then we will talk about how we're going to move it forward, how we're going to finance it, or how we're going to get it to the next stage, and what it'll look like when it gets there. So, again, none of those questions keep me awake at night. I think it's going to be fairly good because, as I said, this is the best development asset in Brazil now. So,
all right. Hey, Nick, I really appreciate your time. If anybody has any follow-up questions, you can contact the company directly through that email address that's on the screen right now. You can also email me. That is fleck@kereport.com. I'll be bringing Nick on my show to answer any of those additional questions and also follow up on additional news. Everybody, thank you for tuning in. A replay will be made available. First priority to everyone who had registered. And hey, Nick, again, really appreciate your time. Thank you for taking time to share some of the new information out of the company.
No, it's an absolute pleasure. Thank you very much.